The top business stories live from the Sky News City studio. The UK labour market appears to be cooling as wages grow at their slowest pace in nearly a year. Shell announces it's going to sell its onshore oil and gas operations in Nigeria after almost a century in the country. Plus, why company insolvencies in England and Wales look set to have hit a 30-year high. Good afternoon. This is Business Live with me, Ian King. UK wages grew at their slowest pace in nearly a year, according to figures published today, raising hopes that inflation will soon fall sufficiently for the Bank of England to begin cutting interest rates. The Office for National Statistics said that during the 3 months to November, annual growth in earnings, excluding bonuses, slowed to 6.6%. That was down from 7.3% in the 3 months to October and represented the slowest rate of growth since the 3 months to January last year. The figures mean that wages have now risen more rapidly than prices for 5 consecutive months. Some other business news is for you now. And the oil major Shell is to sell its onshore oil and gas operations in Nigeria after almost a century in the country. The assets are being sold to a consortium of 5 local businesses called Renaissance for up to $2.4 billion, depending on future performance. Shell first set up operations in the country in 1936, but the business has had a troubled past, with its pipelines frequently being sabotaged. Shell will retain its 25.6% stake in Nigeria LNG, which produces and exports liquefied natural gas. The brokers Panmure Gordon and Liberum are merging to form what will be the UK's largest independent investment bank. The combined business, to be led by Panmure's current chief executive Rich Ritchie, will become the largest advisor to UK-quoted companies with more than 250 retained corporate clients. Well, the deal is the latest in a wave of consolidation in the sector over the last year, with FinCap and Cenkos merging and Deutsche Bank acquiring Numis Securities. And Ocado said today that Ocado Retail, its UK joint venture with Marks & Spencer, would return to positive earnings this financial year after enjoying its highest ever level of sales over the Christmas period. It said that sales at Ocado Retail between the 20th and 24th of December were up 7% on the same period in 2022, including a record day for items delivered on the 23rd of December. Well, the news comes 2 months after Stuart Machin, the M&S chief executive, said he was positively dissatisfied when Ocado Retail reported a half-year loss. And the UK infrastructure investor Actis has agreed to a takeover by the US private equity firm General Atlantic for an undisclosed sum. Well, the news comes days after the fund management giant BlackRock agreed to buy Global Infrastructure Partners, the owner of Edinburgh Airport and part owner of Gatwick Airport. Actis, which has $12.5 billion under management, was founded in 2004, and it was a spin-out of the government-backed Commonwealth Development Corporation. Now, Ryanair's chief executive has insisted passengers are safe in its fleet of Boeing aircraft after he raised questions about quality control at the plane manufacturer. Speaking to Sky News following the Alaska Airlines incident that saw a fuselage panel blow out of a 737 MAX 9, Michael O'Leary said that he was sending a team of engineers to oversee production of 57 aircraft he has on order and that his customers should be reassured.
I mean, we only fly the Boeing 800 aircraft. We don't fly any Boeing 9s. It's the MAX 9 that's been grounded. So the issue doesn't apply. There's none of those aircraft in Europe. Boeing make great aircraft. The MAX is the most audited. It was grounded for 2 years. Most audited, most secure plane in the air, and we're very proud to fly them. But I do think that the quality control, the production control in Seattle has been lax in recent years. And we've complained publicly about it. We've raised it with Boeing, and we and other airlines have been pushing them to improve quality control. It is not acceptable that aircraft come out of Wichita or aircraft get delivered from Seattle with anything wrong with those aircraft.
Now, company insolvencies in England and Wales during the final 3 months of last year look set to have hit a 30-year high, according to Insolvency Service data. Yet administrations, the procedure which seeks to rescue an underlying business that has become insolvent, appear to be levelling off. Figures from the risk advisory company Kroll suggest there were 105 administrations during December, up from 99 in November, but the rolling 12-month figure was more or less unchanged from the previous month. Well, joining me to talk about this is Managing Director at Kroll, well, Matt Ingram. Matt, welcome to you. The fact that insolvencies are still rising while administrations are tailing off, does that mean that fewer insolvent businesses are surviving?
I think, and good afternoon, Ian. I think there's a mixed picture that we see in the statistics at the moment. Liquidations, which tends to be a process that we see smaller companies use when effectively they've run out of cash, run out of working capital, and they're closing a business down. Those are very, very high. We've seen over 20,000 liquidations in 2023, whereas with administrations, we're seeing about 1,500, 1,600. So the smaller business, yeah, there's definitely some pain that we're seeing in the insolvency stats. Administrations, the larger businesses, they're still roughly now where they were pre-pandemic, so we're not seeing a big increase in those kind of numbers.
So this is essentially a good news story.
I think there's a risk that it's the calm before the storm. Of course, there's well-documented macroeconomic factors that still face a number of businesses. I think with administrations, when we see the administration process used, more and more we see that as a mechanism for value to be realised from a business that is otherwise insolvent. And I think that the reason potentially those numbers are still a bit lower than where we would expect them to be is that lack of risk appetite, the lack of buyer appetite. So if you're an investor in a business that's struggling at the minute, you're probably not going to go to market. When that confidence is restored, I think we'll probably start to see the administration stats increase as it effectively helps those transactions execute.
That's very interesting. So potentially you could see more businesses that would otherwise have entered insolvency having a fighting chance in the future.
I think you will, and I think that the actual insolvency process will often be used to facilitate that. But there is still, there is still a lot of cash investment looking for a home at the minute. So those businesses where underlying, ignoring potentially high levels of debt and stretched balance sheets that we've seen over the last few years, if there's a good trading business underneath it, then more often than not there is an option to help that business avoid an insolvency process, yeah.
Now, what are the sort of businesses that you've been handling in administration? It looks as though manufacturing is top of the list.
Yeah, I think if you look at the numbers that the Insolvency Service have released today, you see the usual suspects. Manufacturing up 20% year on year versus 2022. I think we put that down as a result of those macroeconomic pressures we talked about. The standout for me is businesses that are associated around the food sector, food manufacturing, food service. We've seen those year on year increase by 44% based on the numbers that the Insolvency Service have released. And in real terms, that's about 3,500 businesses in that sector have entered into some form of insolvency process. So that's one to watch. Construction, manufacturing, retail, they're the usual suspects. Food's the one that I'm seeing a real movement in.
And why is that? Is that because they've been hit by higher energy costs, or are there other factors at play?
I think, yeah, they've been hit by higher energy costs, inflationary pressures generally. I think what's partially unique to the food sector is particularly for businesses that are perhaps supplying the main supermarkets. It's the buying power of the end customer. So the supermarkets are trying to keep prices down. They're trying to keep good deals for the consumer. So it's much harder for those businesses to pass those input costs they're getting in production onto their customer and ultimately onto the end user. Often they're on thin margins anyway. Yeah. So actually I think we're seeing a lot of those businesses now really struggle for cash.
And of course the other factor is, it's a really tough time right now for hospitality. So suppliers to the restaurant trade presumably are suffering.
And the restaurant trade itself. Again, I think you're absolutely right. I think that in some ways it feels like a perfect storm. Businesses generally that facing the consumer are quick to feel the pinch as consumers spend less, and I think most definitely suppliers into the pubs, the restaurants, the bars will be feeling the pain as well. Yeah.
So as we look forward to 2024, interest rates are probably going to come down. Potentially, would you expect to see the numbers continue to tail off?
In terms of number of insolvencies, I think we will certainly see the liquidations start to tail off. I think those numbers, 20,000+ companies at the minute, they're very high. And I think what you're seeing there is a lot of the so-called zombie companies that we've heard about over the last 15 years. Those companies that quite small, existing just to service very low interest costs. As the interest cost has increased, those companies we're seeing fail. So I think we will see liquidations start to tail off. But I think as the buyer appetite and as the transactional market starts to come back, we could see administrations increase, but hopefully with positive outcomes at the end of those processes.
Sounds like a busy 12 months ahead for you, Matt. Good to see you this afternoon. Thank you. Now, chief executives of UK companies are more optimistic about prospects for the global economy than their international peers. They're also less pessimistic about the UK economy than this time last year, with more than half saying they will do at least one major acquisition in the next 3 years, and nearly half saying they plan to raise headcount by 5% or more this year. Well, those are among the main findings from the 27th Annual Global CEO Survey conducted by PwC, the business services giant. I've been speaking with Kevin Ellis, Senior Partner at PwC UK, and began asking why UK CEOs are more upbeat than their peers.
Yeah, they do seem to be, and that comes across quite clearly, both in terms of their intention to hire more people. I think 50% are hiring more people, but also their desire in the next 3 years to do an M&A transaction, which is double the number that did an M&A transaction over the last 3 years. So the signs of positivity come through, and there's definitely an opportunity for positivity to feed on positivity. Because once you start getting in that mindset, people are more confident about making investments. And we see that coming through, again, in the UK, effectively leading a lot of the big nations in the world in terms of their investment in AI. So I think there's generally a more positive vibe this year, but it was off a low base.
As you say, more than half of the CEOs you spoke to plan to do a major acquisition in the next 3 years. I mean, that'll be music to the ears of any bankers watching. But what about internal organic growth?
Yeah, I think that comes through in the AI numbers and in the hiring numbers. The fact that 50% of the CEOs expect to increase their headcount by more than 5% next year, and that 42% of them have already made an investment in generative AI, again, that passes through to the organic growth side of the equation.
Obviously, these hiring intentions are pretty encouraging, but does the UK have the skills base to meet that demand?
Well, the labour market is certainly tight in the UK at the moment, and therefore I think the role of the UK in retraining, we know jobs are going to be lost by technology changes and AI. We also know that jobs will be created by the same, and therefore retraining people from one to the other I think is a key element of both this report, but also where the challenges are for the UK and other European nations. I think we do have an advantage over other countries. We have a really significant business-led professional services sector. I would say that, wouldn't I? And therefore, as a professional services sector, we need to train people. Being a magnet for talent and growing talent is part of our kind of business model. And that, I think, helps with the retraining challenge that the UK faces.
Now, as regards prospects for the UK economy in particular, I mean, it's notable that CEOs you spoke to are less pessimistic about the UK than they were this time last year.
Yeah, I mean, this time last year, I think only 9% were positive. So it's a significant leap up, but again, from a very low bar. And we're still less than 50% are positive about the UK economy. But again, I think confidence breeds confidence. And therefore, the more that people start talking about doing transactions and making investments, the more that confidence grows.
Do you think this is influenced in large part by the fact that we're likely to see cuts in interest rates this year, or do you think there's more to it than that?
I think that's a big factor. I think once people see the top of the interest rate cycle, they feel more confident in terms of their debt repayments and how their models work. And again, we as a firm have definitely seen an uptick in buy-side mandates and activity in the deal sector that really started to take place in kind of the end of November and early December. And that's an unusual point in the cycle to see that happen. And again, like any deal cycle, there's always a FOMO factor, the fear of missing out, which I think does drive behaviour.
What about geopolitics? What have you heard there?
Yeah, there's a big kind of cloud of geopolitics hanging over us in terms of the worldwide challenges. But again, does that impact interest rates? Does it affect the supply chain and therefore scarcity of supply, thus pushing up pricing, thus pushing up inflation? That's probably the kind of short-term concerns on most CEOs' minds.
On a brighter note, looking at inward investment, the UK is still the top destination for American CEOs looking to invest overseas.
Yeah, I think it was interesting that last year we were third equal in terms of where were the destinations that CEOs around the world wanted to invest. We've only slipped down to 4th, which is very close, but more importantly, we're number 1 for the US, and we've moved from 16th to 6th for the Chinese. Those are two big investors in the world, and the fact that the UK is their destination of choice, again, I think is a really positive sign. And sometimes in the UK, we are quite hair-shirt, so I think seeing how the rest of the world sees us, rather than how we see ourselves, again, is another source of chinks of light.
Yeah, big shift in the attitude of Chinese CEOs. What do you think's behind that?
I don't know. I just think, again, sometimes in these surveys it's hard to actually put reason behind it. But again, it's sentiment. And when one or two start investing in an area, again, we're rich in skills, we're rich in innovation, we're leading the charge on generative AI. I think all of those are factors.
Now, obviously, we're likely to have an election this year, Kevin. What are you picking up on the ground in Davos in terms of the approach that people might expect an incoming government to adopt?
I think at the moment everyone just wants certainty. I don't think the election is going to change the deal cycle or the economic cycle in the UK. I think people have kind of built that into the price. I think more importantly, everyone's kind of looking across the Atlantic at that election in terms of what that means for the world at the moment. But again, I think most of the world is looking at elections in most of the democratic world this year. So there's been lots of things to catch people's eyes on that front.
Now, this is your last Davos. What are your reflections on the events that you've attended over the years? How's it changed?
I think it's always interesting. When you walk along the main street of what is effectively a ski resort, it's who's here. But you go back 3 years, it was all crypto, it was all blockchain. This year, it's all AI. There's also a shift in country. You can definitely see a huge Indian presence and a huge Middle East presence. So as a trade fair, I think that's indicative of where people are investing, but also who is doing the investing.
Not sure the Davos organisers will be too pleased at him describing their event as a trade fair, but he's probably right. Anyway, still to come here on Business Live. We'll have a look at how the markets are doing this afternoon. Don't go away.
I'm Martha Kellner and I'm Sky's US correspondent based here in Los Angeles.
It's turning everybody into, a crazy, violent drug addict.
How are you feeling?
I am angry. Legal abortion! It is an anti-woman agenda.
2 women say that you paid for their abortions. Are you a hypocrite, sir? Will your candidates win?
I hope so. I think they will. I think they're great candidates.
I gotta be realistic. My sister's dead.
More than 4 weeks on, there's no murder weapon and no suspect. Are you going to catch this killer?
We are doing everything we can.
Ghislaine Maxwell has pleaded not guilty to all 6 charges against her. Mum, how are you feeling today?
Jeffrey said, you answer to Ghislaine, you just don't cross her.
They're so excited.
Severe nightmares of these people coming in and just taking me in the middle of the night.
I've watched as whole towns were torn apart by natural disaster.
I'm alive and I'm thankful for that, but there are a lot of people who aren't.
It's not the winds people fear most here, it's the water. We take you to the heart of the stories which shape our world. Do you truly believe what you're saying?
A lot of cases that I know are reported from Ukrainian missiles themselves.
Ambassador, with respect, I think that's preposterous.
Fly Emirates. Fly better. Fly Emirates. Fly better. Thank you.
Well, European stocks have finished largely to the downside this afternoon as expectations of early interest rate cuts from the European Central Bank have been reined in. Talking points today include Hugo Boss. The premium fashion group is down 11% in Frankfurt after its quarterly profits came in below expectations. Well, here in London, the FTSE 100 also finished in negative territory, off nearly 0.5% in a broad-based sell-off. The leading blue chip fall in percentage terms was Rightmove. That was on adverse broker comment. While AstraZeneca has fallen for similar reasons. It's clipped nearly 13 points off the index on its own. Elsewhere, there aren't too many gainers to mention, but the credit data provider Experian is ahead 2% or so on a trading update, now 2.5% at the close. To the outside the FTSE, the networks testing specialist Spirent Communications, former FTSE member, that finished up 9% after reassuring investors on trading, but Money Supermarket has fallen 7%. That's on a broker downgrade. Over on Wall Street, it's been a largely downbeat opening after yesterday's public holiday. Talking points this afternoon include Goldman Sachs, which has reported its lowest annual profits for 4 years. The shares are currently ahead, though, some 1% as the number beat expectations. On the foreign exchange markets, well, it's been a day of dollar strength, as you can see. Sterling off 0.5% against the greenback, unchanged against the euro. The single currency likewise off by just over 0.5% against the dollar. As for the oil price, it's gone next to nowhere for the last 3 sessions. Now it's perked up a little this afternoon. A barrel of Brent crude currently changing hands at $78.58 a barrel. That's up a little 0.5% higher on the session. Well, joining me this afternoon is Neil Wilson, Chief Market Analyst at Finalto. Neil, good to see you this afternoon. Dollar strength, tell me all about it. It's down to some comments that we've had out of the Fed.
Yeah, it's been a sort of mixed couple of days in terms of the interest rate picture, because we had the ECB officials out yesterday, some pretty hawkish noises from them saying that there might not be any interest rate cuts this year. The Austrian Central Bank Chief Boltzmann saying that, and then today we've had Fed Governor Waller suggesting that as long as inflation doesn't tick back up, then there will be rate cuts this year. So we've had this sort of mixed story. I think you've seen some dollar strength creeping back into the market, really over the last sort of month or last couple of weeks, certainly. And it reflects, I think, probably a bit of de-risking. I think people have just come a little bit risk off for the last couple of weeks since Christmas, since that sort of ramp that we got from the end of October through to Christmas. The tone has been a little bit more risk off. That tends to favour the dollar. And the market is kind of assessing whether or not we're going to get as many rate cuts this year as they had anticipated. And our belief here, and my belief anyway, has been that the market's been too optimistic on that front. And I think a lot of investors maybe just come around to the view that the sort of 6 rate cuts this year is less likely than maybe they thought.
On that basis, Neil, would you expect the equity markets to tread water for the next couple of months?
Yeah, I think, we've seen that last couple of weeks, really the start of the year, has been kind of going nowhere in terms of the equity markets. And I think until you get a clearer picture from the Fed in particular and other central banks, then I think, markets have kind of they've run up so much and kind of priced in a kind of Goldilocks scenario of lots of rate cuts, but also benign growth environment and, that soft landing narrative that we've heard an awful lot about over the last few months. And so that picture, I don't think there's particularly a massive downside catalyst in the offing. I mean, you never know, but the likelihood is that we're waiting to March into April, May, and then we get a much clearer idea about just how many rate cuts there's going to be this year, and also just how much the tightening that we've already had, all these rate hikes that we've seen, just how much damage they might have done. And there was a bit of an indicator today about that in the US, and the survey data that was pretty weak, but I think the market's looking through that one for the moment.
And of course, Neil, also, I mean, you could certainly see that in Germany. I mean, probably the only G7 country in recession right now.
Yeah, that's right. Yeah, I'm sure we could probably blame Brexit for it, or some people probably could. But yeah, it's you know, the German economy's been struggling for a while. The manufacturing sector's been struggling for a while. You can put that down to lots of factors. But ultimately, you know, the ECB is maintaining quite a hawkish bias still, and until it starts to cut rates, you probably won't see a turn on that front. So I think there's pressure on the economy, and that pressure's it's there for a reason. We need to remember that it's there because the central banks are trying to get a grip on inflation. And I think the key thing is that the central banks are so cautious right now. They were really, you know, they've been burnt before about, you know, when they cut too soon or they hike too soon.
I'm so sorry, we're out of time. I'm going to have to cut you off. Sorry. Good to see you this afternoon. Thank you. That's it from me. I'm back at 11:30 tomorrow morning with the next edition of Business Live. Hope to see you then. Coming up next, it's the News Hour with Jonathan Samuels. Cheerio.